Hello everybody, welcome to my channel. Today we are going to discuss on bank reconciliation statement. Hope you would have watched the earlier short video which you had posted on why we need to prepare the bank reconciliation statement. So we are going to look in detail in this video about what is bank reconciliation statement, and we'll try to solve a problem as well. Before we move further into today's video, I would like to give a brief introduction on the topics which we will be covering in today's video. First thing is we'll understand what is bank reconciliation statement, why we need to prepare the bank reconciliation statement. Third, we are going to see the differences which are reflected in a bank reconciliation statements and the categories of the differences, whether these differences, all these differences to be counted, or they are just differences for the presentation purpose, which requires a entry in the books of accounts or does not require an entry in the books of accounts. We will see all those details in the third section. And finally, we will work out a problem in detail, taking into account the understanding of what we have got from the bank reconciliation statement. If you're new to my channel, then I would like to introduce myself. I'm Srinidhi and I post short lecture videos on accounting and finance every week. And I also take up topic suggestions from my subscribers. So you could consider subscribing to my channel and leave a comment on the topic that you're looking forward so that I could come up with the topic in my next video. Now let's move on to today's topic. Let us first understand what is bank reconciliation statement. So it is a statement which is prepared to identify and track the difference between the balance as per the passbook, bank passbook, and balance as per the cash book, which is being maintained by the entity. So we as individuals will track the bank balance during the month, right? So based on the transactions which we have entered, we will have a mind calculation on what would be the approximate bank balance as on day 3. This is something which we do in a very unstructured manner on a day-to-day basis. We maintain rough expenses made so far and the income which is being credited in during the month, and we will find the balance as of now. So this is something which we do in an unstructured way. So whatever we have been doing in an unstructured way is nothing but we do it in a structured way for an entity on a timely basis, in order to identify what are the differences and why the difference has arisen between the balance as per the cash book and balance as per the passbook. This is what is a bank reconciliation statement. Now let's understand why we need to prepare the bank reconciliation statement. There are three main reasons why we need to prepare the bank reconciliation statement. One is we need to find out the errors and gaps between the cash book and the passbook, which is very important because we might miss out some of the expenses which the bank had considered, like the bank charges, or we might have excluded some interest which has been credited, which would be in the bank passbook, but entities accountant would not be aware of such transactions. So it is very essential to maintain the books of accounts accurately, correct? So for that, we need to find out the reason for the difference and we need to book the entries in the books of accounts accordingly. Second reason is there could be any delay in clearing or presenting of this check. In these cases would also be a reason for the difference, and we will get to know by preparing the bank reconciliation statement. Third, better control over the books of accounts that we maintain by the entity, as well as it also discourages any embezzlement of funds by the bank, so that we know that any transactions which have been taken place, any fake transactions or any transactions which we have not entered into, which has been funds have flown out, which we have not entered into. So such fraudulent transactions also we will get to know if we may do this process of preparing bank reconciliation statement on a periodical basis. One main thing what we need to understand from this preparation of the bank reconciliation statement is, while preparing the bank reconciliation statement, we will get to know the differences. And these differences are being presented in a bank reconciliation statement. But all these differences do not require an entry in the books of accounts. So we can classify these differences into two. One set of differences are those which require entries in the books of accounts, and other set of transactions are those which not require, any entries in the books of accounts. So those which require entries in the books of accounts could be like the bank charges or the interest or any check which is being directly deposited by the debtor into the bank. These entries would require an entry in our books of accounts. However, there are some entries which do not require books of accounts, like any timing difference which we have accounted, but check which is being issued but not cleared. These are timing differences which doesn't require any entry in our books of accounts. It is just for our understanding that it gets reflected in the bank reconciliation statement. Hope this is clear. Moving on to the third section, that is, what are the types of the differences which will get reflected in a bank reconciliation statement? Based on the need, that is the reasons why we need to prepare, we will see the examples of the such differences in this section. So we have already seen that the need to prepare the bank reconciliation statement. One is to find out the errors or gaps between the cash book balance and the passbook balance. So this could be any clerical error of the amounts by the bank staffs or by the accountant of the entity. It could be the bank charges or the interest received on the passbook or any other transactions like any check is being deposited by the debtor directly into the bank. These could be such transactions which are the gaps. Gaps between the cash book and the passbook balance, or there could be a standing instruction. So if such standing instructions the accountant of the entity has not booked into, could also be a reason which would get reflected by preparing the bank reconciliation statement. So what these are like the nature of transactions which would require entries in the books of accounts. But these are the errors in either ways requires correction. These are the errors which require correction. In either the bank perspective, it is made by them or by the accountant of the entity. Moving on to the second reason, what we saw was any delay in clearing of the check or presenting of the check. So the checks which are issued but not presented, or checks which are not cleared. This could be one example, or it could be like checks received but we have not yet put it into the bank, so it's not been collected. So checks received, but we have not collected the amount is not yet being credited into our account. So these could be, for this the accountant would have already booked an entry in the books of accounts, but since we have not deposited those checks into the bank, it is not yet reflected in the bank. So these are the timing differences. That is because of the delay in the clearing process, these differences could arise. These timing differences would be accounted only if it falls below the cutoff date of preparing of the bank reconciliation statement. For example, we are preparing on 31st March and the timing differences was there on 27th of March and it got cleared by 28th March. What does that mean? When we prepare the bank reconciliation cutoff date, that is 31st of March, we have already cleared, the checks have already cleared. So only those timing differences which are still pending as on the date of preparation of the bank reconciliation statement will get reflected in the BRS. I hope this point is very clear. And the third one is it discourages any embezzlement by the bank, or at the same time, it also enables better control. It also has better control over the amount which we have in the bank. So in a way, it discourages embezzlement of the funds and avoids any errors. Any fraudulent transactions also get reflected if we prepare the bank reconciliation statement on a periodical basis. So it is very important that we prepare the bank reconciliation statement on a periodical basis. Now let us look into an illustration. In this example, I have taken an overdraft balance, higher level of complexity. So based on these transactions, we will arrive at the question is to calculate the balance as well, cash. So let us go through the problem for once. The overdraft balance as per passbook is 15,000, which means that it is a negative balance. Right. Next is interest on overdraft, insurance premium paid by the bank, check issued but not yet cleared, and wrongly debited by the bank. So these are the 1, 2, 3, 4 transactions which we need to take into account in the bank reconciliation statement. Moving on to the first, interest on overdraft. So what would be the nature of these transactions? Interest on overdraft would be available only to the bank staff, right? So the accountant would not be aware. So this is a transaction which we need to account in the books of accounts. We need to consider in order to arrive at the cash book balance. Okay. So one thing is now what is the objective? We need to set what is the objective. Where is the start point? So when I tell objective, we need to fix the start point, whether it is the cash book balance or the passbook balance. So in this case, our start point is the passbook balance and we are going to arrive at the cash book balance. So for that, what we need to do is we need to mentally understand what are the transactions which would have been there in the cash book, which would not be there in the cash book given the situation. Okay, so 15,000 is the overdraft balance which is as per passbook. From this, we need to arrive at the cash book. So first we have taken the start point is bank passbook. Okay. The next step is we need to understand in order to arrive at the cash book balance, whether the particular transaction which will be there in the cash book or will not be there, will have an impact or will not have the impact. So we need to assess the impact of the particular transaction, and depending on that, we need to whether we need to add or less or no effect, which we need to decide. So the third is the decision making. Now we have fixed the objective at the start point, that is, it is a passbook. Next, we will look into the impact. Interest on overdraft. Will it be there in the cash book or not? No, they will not be aware. So what we need to do is we need to nullify this impact in the cash book. So for that, the interest on overdraft, which is an expense, right? This expense need to be reversed. So expense in the passbook is a negative. So reversing it is a positive. So this balance is to be added back to the passbook in order to arrive at the cash balance. The second scenario is insurance paid by the bank, insurance premium paid by the bank. So in this case, the premium is being paid by the bank, which the accountant is not aware. So similar to the first transaction, this is an expense which we need to add back in order to arrive at the balance as per the cash book. Third is check issued but not yet cleared of rupees 8,000. So this is a check which we have issued, means the accountant would have already debited for this expense, but it is not yet being cleared, means the impact is not yet there in the passbook. So it is not yet being deducted. So in order to arrive at the balance as per cash book, we need to reduce this balance of 8,000 in order to arrive at the balance as per cash book. And finally, wrongly debited by the bank. So it is a debit which is being wrongly done by the bank. The bank has to correct on the one hand, and also in order to arrive at the cash book balance, this debit has need to be added back in order to arrive at the balance as per the cash book. So now we know the action which we need to take in order to arrive at the balance as per the cash book. So now let's move on to preparation of the bank reconciliation statement. So we have already noted down the effects of these transactions. We need to just give impact and arrive at the cash book balance. Let's start from the balance as per passbook, which is an overdraft balance of 15,000. First, interest on overdraft. So this is something which we need to be added. Second is insurance premium, which is being paid by the bank, which the bank would have paid. And in order to arrive at the cash book balance, we need to reverse that 500. Third is check issued but not cleared. What we need to do with this? We need to deduct it in order to arrive at the cash book balance. Because we check issued, which is already being debited in our cash book balance. Since we are starting from the passbook, we need to less this in order to arrive at the cash book balance. And wrong debit by the passbook, which is to be reversed by the bank, as well as we need to reverse that in order to arrive at the cash book balance. So now let us arrive at the cash book balance. So while preparing the bank reconciliation statement, it is very important to note the date, because the date on which we are preparing the bank reconciliation statement is very important, because that is the cutoff date which we need to consider for our timing differences also. There are much complicated problems. Maybe I'll come up with in a separate video with some complications in it. We will solve a bank reconciliation problem with these small intricacies separately in detail. So let us arrive at the cash book balance. We will just give the impact for this. So as per cash book, the overdraft balance is 20,300. Okay. But as per passbook, it is 15,000. But actually, the balance as per the cash book is 20,300. So if you give the signage at the beginning itself, then you have to just give an add less, add less. So don't get confused. If it is an overdraft balance, just take the overdraft balance as negative and give the same impact of the add and less in order to arrive at the cash book balance. So with this, I hope that you had a brief understanding of what is bank reconciliation statement, why we prepare the bank reconciliation, the need, and what are the types of differences which get considered in a bank reconciliation statement. And finally, we also saw an illustrated problem solving the bank reconciliation statement. There are many small intricacies which we need to take into account while reading a problem in order to solve a bank reconciliation statement. Maybe I'll come up with a separate video solving a detailed problem taking into consideration of these complexities of the transactions in a later video. I hope the illustrations and the examples which were given were useful. Finally, don't forget to like, comment, and subscribe to my channel. Thank you.